Let's say you have two friends, Amit and Rohan, and they both want to start a business. And they both have 10 lakh rupees to start this business. So they started this and they went on for a year. After 1 year, they calculate the profits and Amit realized that he has earned 1 lakh from this initial investment of 10 lakhs, while Rohan earned 2.5 lakhs from this initial investment of 10 lakhs. Now they both have come to you and they are asking you to invest money in their business. Which one will you pick? Well, the question is not that difficult, and obviously you will pick Rohan because he is a better businessman. He has earned almost 25% profit from the initial investment that he has done. Now, this is exactly how ROE works in the stock market.
High return on equity over a long period of time, to us at Jensen, we believe is indicative of a really strong company that's able to make money in good times and bad, which is why we call them all-weather businesses.
Found back in the 70s that ROE was fairly stable over long periods of time, so it became an issue.
There are very lot of low return businesses, and that was true even when the Japanese economy was booming. I mean, it's amazing. They had an incredible market without incredible companies. They were incredible in terms of doing a lot of business, but they weren't incredible in terms of the return on equity that they achieved. And that finally caught up with them.
This tells us how efficiently a company is generating profit from the money that the investors have put in. And in this video, I'll explain it to you in detail how to use ROE to pick the best companies, and this can literally help you compound your wealth in the next few years. So let's begin. In this video, we'll cover these 5 things. First is what is ROE and why is it so powerful? Then we'll understand how to calculate ROE. Then we'll understand what range of ROE is good. After that, we'll understand how to use ROE smartly and not blindly. Finally, we'll do one live case study to understand how to pick the right stock using ROE. Now please watch this video till the end because there's a huge ROE trap. And a lot of investors fall into this trap and they burn all their money. I'll tell that also in this video so that you avoid that mistake. So what is ROE and why is it so important? ROE is return on equity. It basically tells how much profit a company generates per rupee of investors' money. And how do we calculate this? What is the formula? Net profit divided by shareholders' equity into 100. Now, if you understand this formula, we have the net profit in the numerator, which is the profit the company makes in a year. And then the denominator is shareholders' equity, which basically is assets minus liabilities. And then into 100 to make it a percentage. Now, if the ROE is 20%, it basically means for every 100 rupee invested in that company, it generates 20 rupees profit. If the ROE is 5%, it basically means for every 100 rupee invested in that company, it generates 5 rupee profit. So which is a better company? Obviously the company which generates 20% profit out of every 100 rupee invested in it. And this is why it is extremely important to look at a company that generates a lot of money. In fact, Warren Buffett used to see how consistent the returns are of this company. See, if a company generates this ROE for just 1 year, it makes zero sense. You have to see, is it consistent? Is it consistently delivering 20% return every year for the last 5 years? Only then we can say the company is great. So now you know the formula, so you can calculate ROE. But the natural next question would be, what should be the value? What is a good ROE? And for that, there are 3 basic ranges that you must know. The first thing is less than 10%. If the ROE of the company is less than 10%, it is usually bad. Think it like this. When you put your money in an FD, it gives you a return of almost 7 to 8%. Now, if a FD gives you a return of 7 to 8%, what's the point of investing in a company that generates 10% profit? Because in fact, even if you just invest in Nifty, it gives you almost 12% CAGR, return year on year. So what's the point of investing in a company that generates just 10% profit from the investors' money? So generally, if the company is generating less than 10% ROE, it is usually bad and avoid it. The second range is 10 to 15%. If the ROE range is between 10 to 15, it basically means the company is not great, it is just average, but you can consider if it is growing. Let's say the ROE for last year was 12 and now it is 14. Maybe it is good because it is going up, but again, not great. If it is less than 15, it is not great, to be honest. You should aim for companies that are more than 15, and that is our third range. If the ROE is more than 15, this basically means the company is great. It is growing at a really fast pace. For every penny you put in the company, it is generating almost 15% profit. And this is the kind of company you should aim for. Now, one thing which is extremely important here is you should look for consistent ROE. ROE value, you can't just look at for 1 year and just do your investment. You can't do that. You have to look at for the last 5 years how ROE has changed for this company. If the ROE has been consistent and growing, that is the best. For example, the ROE 5 years ago was 20 and then it was 22, then 24, 26 and then 30. It is great because the company is constantly increasing its profit. And these are the companies that will give you the maximum return in the longer term horizon. In fact, these are the companies that will make you a crorepati. Trust me on that. So if the ROE of the company is, let's say, 40 or 50, does that make it a great company? Maybe not, because you cannot look at ROE independently. You have to look at a bit more indicators to come up with this conclusion that the company is great. And why? I'll explain it to you with the example again using the formula. So the formula was net profit divided by shareholders' equity, which basically means, if you have learned maths, if you increase the numerator, obviously the ROE value will increase, and that is the right way because the company is increasing its profit, so naturally the ROE will go up. But the other way, which is a trap to increase ROE, is decrease the denominator. And how do you decrease the shareholders' equity? It's very simple, by doing buybacks. If the company does buyback of the shares, it will reduce the shareholders' equity and will artificially bump up the ROE. And how? See, if the company has, let's say, 50 crores cash and the company uses this cash to buy back the shares, what has it done? It is basically has reduced the assets, and cash comes under assets, has reduced the assets and bought back the shares, and these shares would be as negative in the balance sheet. Now, shareholders' equity, the formula for that is assets minus liabilities. Now, I've burned the cash because I've bought these shares, so my asset has reduced, liability remained the same, which basically means my shareholders' equity will reduce by 50 here. And that basically means my ROE will increase. Is it the right way? No, it is a trap. So you must look at, if the company's equity is decreasing, then there's no point looking at ROE, because the ROE will naturally go up if you reduce the shareholders' equity. And this is one thing you should always look at. The second thing, which is very important, if you have noticed this formula, it says shareholders' equity. It is not factoring in debt. Now, the first example I gave you of your two friends who have invested 10 lakh rupees and got this profit of 1 lakh and 2.5 lakhs. Imagine one of those friends just had 5 lakh rupees and the remaining 5 lakh he got a loan from the bank. What will be the impact on ROE? It will change because it just considers ROE, which is return on equity, and here the equity would just be 5 lakhs. Then the 1 lakh profit he has generated would be out of 5 lakhs. That makes ROE as 20. It just doubles the ROE, and hence you should not look for ROE when the company is high on debt. And that is the reason one more indicator you will have to add on to your filtering criteria would be debt to equity. Generally, if the debt to equity is more than 1, ROE makes 0 sense because there is so much debt to fuel the growth, there is no point looking at ROE then. And the third thing is one time increase in ROE. For example, let's say a company has plants in, let's say, 10 states in India, and suddenly they plan to stop their Maharashtra plant and they sell the entire plant from there. That basically means for this one time they will get a lot of money after selling that property, and that will be factored in net profits, which basically means the ROE will increase for this particular year. It does not make this company great because this has sold some of its property, which has artificially boosted up its profit for this year. Next year it will again reduce. You should always look at that. One time jump does not make any sense. When you look at ROE, it should be consistent for the last 5 years. Only then you should consider investing in that company. Now, to explain this further, let me take a real life case study, and for this I'll take you to 2017. So we had two banks, Yes Bank and HDFC. During that time, Yes Bank had a ROE of 18%, and guess the ROE of HDFC? 16%, which basically means which bank is better? Obviously Yes Bank, right? No. In fact, a lot of investors thought Yes Bank is better, and a lot of people invested in Yes Bank and they almost lost all the money. 5 years later, I think within 2021, Yes Bank crashed by almost 95%. while HDFC Bank has been consistently growing and will grow in the future.
Yes Bank, which is the top loser on the Nifty, down around 2.6%.
The PMC Bank fiasco last year, now the Yes Bank crisis. The depositors are asking, is our money safe?
Yes Bank founder Rana Kapoor this morning in the early hours around 4 a.m. had been taken to the ED office in Mumbai on Saturday for questioning, and this comes after raids were conducted at his residence in Mumbai on Friday. A case has been registered against him under the Prevention of Money Laundering Act.
And why did this happen? Because if you looked closely, Yes Bank was sitting on a lot of debt. If you had looked at debt to equity during that time of Yes Bank, you would know it is not the right bank to invest. Along with that, it had a lot of bad loans. While on the HDFC Bank, the debt was manageable, and at the same time, there was no bad loans. By the way, when you look at banks, do not look for debt to equity less than 1 because banks generally carry a lot of debt. But Yes Bank had crazy amount of debt. Along with that, bad loans. So Yes Bank crashed and kept crashing and literally crashed completely to like 95%. And HDFC Bank has consistently been growing. So do not look at ROE alone, look at a lot of indicators when you pick a company based on ROE. So what should be the strategy for stock picking using ROE? I'll tell you like 4 steps that you can use. Step 1 is see if the ROE of the company is more than 15%. And again, look for consistent ROE. The average ROE for the last 5 years should be more than 15% year on year. That is step 1. Step 2 is look for debt. Debt to equity generally should be less than 1. I'm a bit more conservative, so I try to see all the companies who have debt to equity less than 0.2. That is the second step. Third step is see if the ROE is constantly improving with time. That is the third step. And finally, fourth step is compare this with the peers. Do not compare ROE of, let's say, banking with FMCG. It makes zero sense. Compare with the stocks in the same industry. That is the fourth step. Now, it is very complicated, right? How would you find out all these companies? It is not that complicated. In fact, in this video, I have done this in detail. I've used Screener, built the entire query and found the exact stocks that you can invest in using ROE and couple of more indicators. Check this video and this will give you all the details about how to pick the right company and how to invest in it and how to find the great companies using ROE and all these filters using Screener. And I'll see you next week. Bye-bye.